Welcome to our podcast series, Talking with Traders, hosted by expert trader Garth McKenzie in London, from where he's interviewing various guests on the topic of trading.
Welcome back to Talking with Traders. This is the 5th season of the podcast to take us up to the end of 2022. Thanks to all our loyal listeners for returning, and welcome to all our new listeners. As before, IG Markets have come on board as sponsors of this podcast. We're truly grateful to have such an award-winning CFD provider as sponsor alongside us. In this season, I'll welcome back some guests from the previous seasons of the podcast to get their updated market views, and we'll also be bringing in some new guests to the microphone too. As always, the aim with these podcasts is to give you the opportunity to listen to differing market views and to assist you with your own trading and investing education. So with that in mind, let's get straight into another episode of Talking with Traders. Welcome back to another episode of Talking with Traders, and I'm delighted to welcome once again the Finance Ghost. This is the third time we're catching up, Ghost. And it's been more or less a year that we've chatted every year since I started this podcast. I was looking back at my notes, and it was around about October of last year, October 2021, that we last spoke. And here we are in October 2022 doing it again. Welcome back to the podcast. Tell us what you've been up to since we spoke the last time.
Thanks, Garth. It's so nice to do these with you. This is, as you say, the third one. And luckily, because this business has grown from zero at the start of the pandemic, I guess there's always a cool story to tell every year.
Yeah.
At some point, that will surely slow down. But it has been a really busy time. I mean, I think probably the biggest change for me has been Ghostmail moving to a daily publication. It kind of got merged with Connect, and now it goes to a nice big audience on a daily basis. So I've now had to experience what it's like to take two very different publications and try and merge it into one for an audience and try and hang on to that audience. So there's always something to learn. And even outside of the markets, I think that's what's fun with what we actually both do is it's the markets, but then on top of that, it's running a business around the markets, which just makes life particularly interesting, doesn't it?
Yeah, it absolutely does. Yeah, it's fun though, paddling your own boat and, knowing it's small enough and nimble enough that you can pull your own levers to change things and change direction quite quickly. Both you and I do come from corporate backgrounds earlier in our lives. And I think both you and I know that can be quite frustrating, especially if you're an entrepreneurial type of person and you want to be able to be nimble and move quickly. Unshackling yourself from the corporate bureaucracy is quite liberating, isn't it?
Yeah, I'm unemployable now. So people say to me like, what keeps you going? I'm like, well, there's no possibility of me failing because I am literally unemployable. Once you've tasted that ability to just change something in the space of 2 hours or decide how to spend your afternoon, you can't go back. It's like a horse bolting into the, into the fields. It doesn't want to go back to the stable.
Yeah, absolutely. It doesn't. So you've done a lot in the last year. As you said, you've partnered up with Connect, which has made your distribution of Ghostmail such a lot bigger than what it was previously. I must say, you probably find that everybody listening to this podcast is already receiving that Ghostmail emailer every morning, because I know it's a big database. But if any of you listening to this are not receiving Ghostmail in the morning, you really should subscribe to it because it's absolutely brilliant. And what I particularly like with what you're doing there is the Ghost Bites, which is essentially where you take the previous day's market news, the SENS announcements, anything that's significant in terms of company developments or economic developments, and basically package it into a very neat, tight, easy to read and quick to read emailer that keeps you up to date with what's going on with various companies, results, corporate actions, etc., etc. That's exciting. But obviously also what we spoke about last time was your Magic Markets premium service. And I was just listening back to our previous podcast. At that stage, you had just started Magic Markets premium. And I think you had only done one episode, which is the episode on Nike. And now I look back, you've covered 43 different companies since then. And I think about 50 different podcasts. So that thing has really, really grown. I mean, that is very impressive.
Thank you. Yeah, we're very proud of it. It's I always lose track of time on these things, but you're right. There was basically only one in the library when we last spoke. So it feels like a very long time ago, but it's not even a year ago. And it has been great. I think Magic Markets Premium is a product that I'm super, super proud of. The whole idea behind it was to take institutional level insights and deliver them to people at a decent price. You know, the overseas substacks written by Americans are hellishly expensive now with what's happened with the dollar. They really are.
Yeah.
And well, I like to think that what we're doing is at least on par with that. I mean, obviously the market decides for itself. You either grow your subscription base if it's good, or you don't if it's not good. But I think what's really fun is to be able to cover such a huge variety of companies. So the reason that, there's 42 companies, I'm glad you've counted them, versus, the number of shows is just because some of those shows are recap shows. So we like to have this feedback loop where we go back and say, okay, this is what we thought was going to happen with these 2 or 3 companies. What actually happened? What's the latest? We typically wait about 2 quarters before we will actually do that. I think we do another recap show. I think we've now had about 7 in a row that are not recaps. The last recap was Disney and Netflix. So that was a nice themed one around streaming. But yeah, it's been great. I love doing it with my partner, Mohammed Nalla, a name that a lot of people also know. I mean, he's held a lot of senior roles in financial services, in markets. So it's lovely. It's a real honor to be able to actually bring this kind of stuff to such a nice audience.
Yeah, it is. And it's brilliant. I mean, it's 99 Rand a month for the subscription. You're getting effectively 4 podcasts a month, but the quality of the work that you do is unbelievable. I mean, I think for 99 Rand a month, it's such good value. It's probably the one debit order that goes off my account every month, which I literally smile when I see that money going off, because I know the value that I'm getting for it is just so immense. And for listeners of this podcast, I mean, I can strongly, strongly recommend that if you're not already a subscriber to Magic Markets Premium, you really should subscribe. It's just the quality of the analysis that you guys do on the companies that you cover is second to none. And I mean, just to list a couple of names, as you said, there's 43 companies that you've covered in the last year. So I'm not going to obviously go through every single one of them, but I mean, there are names there like Nike, Microsoft, Nestle, Tesla, Visa, Disney, Netflix, Starbucks. I could keep going. There's a lot of very, very big, well-established US companies there that you go into. And then these podcasts that you do they're around about 30 minutes long, each of them. So it's not like you have to spend a hell of a lot of time listening. The information is short, sharp, punchy, and it's absolutely brilliant. But now that I've said that, given you a nice plug, which I'm always happy to do, Ghost. What we've decided to do for this episode of Talking with Traders is actually hone in on 3 of the stocks that you've covered recently in your podcasts, just to talk about each of them, and I guess give listeners to this podcast the elevator pitch, is what you call it. In other words, if you were caught up with someone in an elevator for 2 minutes or less, and you had to tell them about a company in that short space of time, how would you go about it? You could give them the elevator pitch. The 3 companies that I want to cover with you are Accenture, Sysco, and Ferrari. And I'd like to do them in that order. We'll keep Ferrari for last because I think both you and I are petrol heads. So there's an exciting aspect to that as well that we'll talk about at the end of the podcast. But let's start with a look at Accenture. I listened to the podcast with you, and I guess with each of these podcasts that I listened to, I came back and I said, what would I kind of give it a label? And Accenture, I came away with the label that I'd call it the glue that binds the Fortune 500. Tell us a bit about Accenture. Give me the elevator pitch.
Garth, we should get you to write our elevator pitches, because that's a very good one-liner on Accenture. So, for those who aren't necessarily familiar with it, Accenture is one of the biggest management consulting names in the world. And the difference with Accenture is they are very technology driven. So this is quite different to a McKinsey or a Bain, for example, which is full of strategy consultants and MBAs and efficiency projects and, which market should we expand into. Accenture does some of that stuff too, make no mistake, but Accenture is very driven by technology-based consulting. So they will come into a group, they will help you with your cloud journey. They will help you figure out what you should be doing in AI or in big data. In fact, if you can think of a buzzword, you will find a consultant. That is the golden rule.
Mm.
And this gives them a really, really cool model. So in the report, we actually joked, welcome to the Hotel California, because these consultants check out, but they never leave.
Yeah.
And the reason they never leave is because these big companies become dependent on Accenture. They like to think that they don't. But you can imagine a situation where the CFO or the CTO, I think it's often the CFO actually, needs to deliver some kind of transformative technology-driven project across the group. And I'm using all the horrible sort of corporate terms that we both left behind and definitely don't miss, but this is how the world works. How do you do that? You're not going to go and hire a team of people to come in and work only for you in delivering this project. It makes no sense. Accenture is a team in a box. It's literally you sign a contract, everyone arrives, they are the right people. Accenture's done all the hard work to find them, train them, make sure they can do their jobs, and bang, you are off and away. Goodness knows you pay for the privilege. But the alternative is not obvious. So people who have never worked with consultants or never seen this in action always think, but why? Why do I have these high paid execs? Why do they still need consultants on top of that? And people forget it's project-based stuff, or it's something that the organization doesn't do in its day-to-day. It's not any different to hiring in an investment bank to help you with mergers and acquisitions. If you are a group that doesn't typically do M&A, you definitely need to get advice or you're going to mess it up. It's exactly the same with Accenture. So, that Hotel California way of thinking is a very, very cool model. It's a wonderful business model, actually. And because so many corporates have done these big tech journeys now, Accenture has really just come into its own in the last couple of years. I mean, it was doing well before then, but the pandemic just accelerated everyone's, digitalization journey, and cloud, etc., is just so part of our daily speak now that there's no, you just can't ignore it.
Yeah.
I must say something, if I can say one other thing that's really impressive on Accenture is the way they've delivered operating leverage. So what that means is basically revenue growing ahead of expenses. And it's unusual because it's a people business. So you kind of think to yourself, well, they'll always make a margin on the next person they hire. But what these guys are doing is they're managing to make more money on each successive person they hire, which is really, really impressive. And I was quite surprised by that.
So just so I understand that, you say that, let's just break it down into a very simplistic example. Let's say you get an Accenture consultant comes into your business. That guy gets billed at 3,000 Rand an hour to the client, and possibly they're only paying the consultant, 2,000 Rand an hour for his time. So are you saying that that obviously they're hiring more and more consultants, all right, which gives them higher revenue line? I suppose every additional consultant that they hire then is just an extra, in that kind of example, it's an extra 1,000 Rand an hour profit, and you're just leveraging other people's time. Is that what you're saying?
That's what you would think, right? But actually, if you look over the years, it's 1,000 profit, then it's 1,005, then it's 1,010. And I think there's a couple of things happening here. So you've got to keep your utilization rate really high. So that's your billable hours. So if you hire someone and they sit idle every Friday, busy Googling the sport for the weekend, you're not making money. So the more of their hours you can bill and get them into clients, obviously the more money you make as Accenture. So that's one point. Utilization rates, though, have been pretty steady over the past 2 years on a quarterly basis. I mean, this is a metric that Accenture reports on because it's so important. So it's not that is driving the operating leverage. So what else is it? Obviously, there are central costs. And if you've got 2 million consultants, or if you've got 20 consultants, your head office still costs you X. You still have a listed structure. You still have a CEO. So that's just a good example of like scale. That obviously helps a bit with margins. But actually what I think is going on here is the pricing mix has actually improved. So because there's such demand for what Accenture is doing, they are able to just constantly look for what is the next best thing they can consult on to maximize what they are able to charge for it. So they are finding ways to increase that charge rate, keep the utilization strong, and manage their central costs. And what that does to your profitability is just gorgeous, honestly. I mean, that is just how you grow, right? That is exactly what you want to see a company doing with your money. There's not a lot of stocks you can buy and just put in the top drawer. But when you see that kind of stuff coming through, you don't need to look every 3 months at how it's doing.
Yeah. A couple of the stats that you mentioned on your podcast really stuck out for me. The one that stuck out the most was that you said that Accenture is in or consults to 75% of the Fortune 500 companies in the US. I mean, that is unbelievable. 75%. It's
amazing, isn't it?
It is amazing. I mean, and you talk about sticky clients, right? Like you said, Hotel California, you can check out, but you never leave. I mean, sticky clients, as you say, once you're in, they're, the companies quickly realize that they can't be without Accenture. 720,000 staff around the world, and growing that quite rapidly, right?
Yes, they are. And they'll keep growing it. As long as the demand comes through, they'll just keep on adding staff. They'll keep acquiring businesses. Actually, that's another point on Accenture that is worth mentioning is they're not shy of acquisition. So what they do, because the Accenture brand is actually just a very strong brand, they manage to stay out of trouble. It's not like McKinsey and Bain in South Africa. Accenture somehow manages to stay out of trouble. And it's one of the big risks to the story is what if they don't?
Yeah.
Just that's a bare point. But for now, they have. And they go and acquire, they've acquired like digital agencies before to start offering those sort of services. So the Accenture brand is just so versatile that they can just jump into a sector. ESG is now the buzzword. Well, what does that mean? It means consultants are ready. What do you do as Accenture? You can go and get your own ESG team, or you can go and acquire people who have already demonstrated an ability to do it and just plug them into your distribution network, right? I mean, that's really what Accenture is this incredible distribution network to win business. Anyone who's ever run their own company will know how hard it is, no matter how great you are as a consultant, to constantly trying to win business and grow your pipeline is super difficult. If you just sell your business into Accenture, move in there, you just get given, the clients just fall from the sky. Their phones ring as opposed to out there hunting for business. It's incredible.
Yeah. And what I liked is, as you said, it's an asset light business. So it's very low fixed assets. I mean, it's entirely an intellectual capital business, effectively. There's no meaningful fixed assets in a business like Accenture.
Just on that, Garth, actually, and that's absolutely right. And a trick when you're looking at a balance sheet, if you see a big asset number, just always go that level down and just look what it is. Because sometimes it's fixed assets, sometimes it's goodwill. If it's goodwill, that's a result of lots and lots and lots of acquisitions of other people, businesses. Yeah. So basically the way the accounting works is if they don't have assets either, you can't recognize assets. You just have to call it goodwill because that's really what you've bought is a brand and people and a team. And that's the story with Accenture. They have a big balance sheet, but it's all goodwill. It's not stuff that eats up capital year on year. They could just stop doing acquisitions if they wanted to and just grow off the current balance sheet.
One of the issues you made mention of in your bear box when you were doing the podcast was that it's quite dollar focused. So in other words, I mean they generate a lot of revenue internally with the US dollar within the US, but they also operate outside of the US in a large way as well. And obviously with the strong dollar at the moment, that means that when they take those offshore earnings and translate it back into dollar profits, the strong dollar hurts them. It's a negative, I guess. So that's one headwind, I suppose, in the short term, given that we've got such a strong dollar. But then that could also turn at some point. I don't think this dollar can stay as strong as it is forever. At some point, it's likely to correct. So that probably could actually be quite a big boost to earnings when you do start to see a weaker dollar, surely.
Yeah, the dollar needs to head back lower at some point. I mean, the world can't carry on forever like this. And it's actually the case for so many American companies. Because we look at so many, it's really interesting. Even the biggest names in the world still make like 70% of their income in the US. And then the rest of the world is the rest of the income, right?
Yeah.
And it's just fascinating. So the US is such a monstrous market and we always forget that. But there is still a big international component to those earnings. And when the dollar is strong, it's not great news for them, let's face it. So that's part of why stocks go down when that dollar gets stronger. As the dollar weakens, the stocks will definitely get a bump. The frustration for South Africans investing offshore is if you take your rand out now, you get killed on the exchange rate. So you buy the dip. But if you look in rands, then you haven't necessarily done as well as you would hope. So the frustration is you've got to try and time the currency and time the markets, and that's not easy.
No, it's not. So you said, I mean, you do own the stock, or you certainly did when we spoke. When I listened to the podcast, you own it. It's in your portfolio. I mean, looking at the share price, it's come down quite a lot since you did the podcast, and over but then so has the whole of the US market. I mean, we're in a bear market. The thing that excites me, and this is maybe just selfishly, but I've been cautious on this market for a while and have largely just been sitting on cash for the whole of the last year. So it's quite exciting to see these kinds of companies getting back down to what looks like far more appealing value. And that's why, just again, to reiterate the importance to the listeners of going and listening to these Magic Markets podcasts, go back and listen to some of the older ones, because there are amazing stories of brilliant US businesses there. And a lot of these businesses are on sale right now. They're trading 30, 40, 50% below the prices that you would have been able to pick them up for a year ago. So, you know, and Accenture is one of those as well. So certainly one that I'd be looking to add to my portfolio now.
Yeah, absolutely. And in each show, you know, for those who haven't, on subscribers who haven't seen one, you know, we go through the technicals and we go through the fundamentals, and anyone who's ever looked at a share price chart will be well aware that it bounces around, and the best you can hope for is a long-term trend. So we always indicate, you know, support and resistance levels, etc. My partner, Mohammed Allah, does all of that, because the technicals are still something I'm learning about all the time, but it's not something that I have tons of experience with. So I know where to play and where to watch. And fundamentally, you know, we actually said in the podcast, like, Accenture can definitely get cheaper. It's not cheap right now. It's one of those, you know, do you want to buy it and own it for the next 5 years? Well, flip, it's hard to make a case against, you know, the question is, will big corporates keep spending on tech? Okay, if yes, then Accenture. Like that. You know,
that's quite simple, really.
You know, sometimes it's not rocket science, right?
No. Yeah, that's it. But I guess also, with investing, the direction of the overall market is half the battle. And at the moment, the direction of the overall market is down. But having said that, that gives you the opportunity to buy these really good companies at better prices than if you had bought them at the top of the bull market. So certainly time to start looking to nibble on these things. The next company I want to chat about is Sysco. Now, this is not Cisco, what most listeners would think is the hardware company that sells routers and networking equipment. Not that Cisco. This is
it's also not 90s music Cisco with bleach blonde hair. Just in case anyone's curious. No.
Yeah, it's not that one either. This is Sysco SYSCO, and the share code is SYY on the New York Stock Exchange. So this is like the Bidcorp of America. Or the Bidvest of America. And I said to you, if I could have put a kind of a headline on it, the one I would have given to this podcast was dividend aristocrat that is growing. That's basically the best way I think I could describe that podcast you did on Sysco in one line. Dividend aristocrat means it's a consistent dividend payer, and not only consistent dividend payer, but the dividend consistently grows. But what is unusual about that is that this is a company that actually is also growing its earnings. A lot of your typical dividend aristocrat companies are mature businesses that are not growing. They've just got to a point where they generate so much cash, they pay most of it out as a dividend, and those are your dividend aristocrats. But to find a dividend aristocrat that is also actually growing its earnings is quite rare. And this company is growing at actually quite a rapid clip. So give us the elevator pitch for Sysco.
Yeah, so you were right on the first one. It is like Bidcorp in America. So Bidvest, when they unbundled Bidcorp, they gave away all their food service businesses effectively. So Bidcorp became this pure play food service business, and that's very much what Sysco is. Much like Accenture, the first step is always, what does the company do and why does it have strong demand? So in this case, what is food service? Well, food service means if you own a restaurant, every day you need to get deliveries of the food that you need for your menu. Now, there is a 0% chance you're going to go and walk around your local grocery store and buy what you need for a million reasons, right? So this whole industry exists that delivers to restaurants, and it's really interesting. It's very integrated. They have all sorts of value adds, like helping you design your menu, because let's face it, you can buy your meat from a whole bunch of different suppliers. I know that fancy restaurant owners will say how they pick their food carefully, and I don't doubt they do. But even then, there will be several suppliers of even, Wagyu beef. That's just how this works. So how do you compete as these suppliers? Well, scale is a big one. Making sure you've always got the products that your customers need and you can always deliver on time. It's a bit like e-commerce, but aimed at restaurants and hotels and caterers. Another way you win is by having value adds like helping people with their menus, etc. So, that's what we saw coming through in Sysco, which was interesting. But really, it's a huge supply chain. It's a massive logistics business. If you can imagine Famous Brands, which is a big franchise player, Famous Brands is a logistics company. They don't own the steers that you buy your burger from. A local someone somewhere owns that steers and pays franchise fees and royalties and everything else to Famous Brands. And Famous Brands is the back end that delivers the food to make sure you know what you're getting when you buy a Steers burger. Now, Sysco doesn't have franchise businesses in the way that a Famous Brands does, but they are the back end. They are everything that happens behind that in making sure that restaurants are looked after. And there's an unbelievable statistic. Cisco, this is almost like the Accenture one on the percentage of S&P 500. It's as crazy.
Yeah.
They serve 50% of restaurant doors in the US. I mean, just fathom Half the restaurants in the US buy from Sysco. Like, that's insane.
Yeah. That was one of the key metrics that I was going to mention. That is just mind blowing. You mentioned in your podcast that this is like the business it sells the shovels in the gold rush, or also think like the wheelbarrows in a gold rush. You don't want to be the guy necessarily taking on all the risk. But if you're selling shovels or selling wheelbarrows in a gold rush, well, you're not taking on any risk. You're just supplying to this massive industry. And that's exactly what Sysco is effectively doing, right? They're just the back end. Like you said, they're supplying the food, they're providing the logistics. The restaurants take the risk. They have the issues with customers, etc., if there are issues, whereas Sysco is just the back end. They're just providing the raw material, really.
Yeah, and I mean, it's the old joke, right, that restaurants are a really good way to lose money, and sadly they are. Most restaurants fail. When they do well, but when they, on average, they don't.
Yeah.
And that's the point here. That's the sort of gold rush is, someone opens a restaurant hoping they are the next Gordon Ramsay in pursuit of this huge, amazing, wonderful story, and a very tiny percentage of people actually get there. But goodness knows you can sell them food along the way. So Sysco's business model is, when someone makes it big in the restaurant industry, great for them. That's not an economic profit pool that Sysco is chasing. Yeah. They just want to make the right margin from a whole variety of people. And it's a great business. I mean, locally, Checkers even plays in this space. They've got Checkers Food Services as a little competitor to Bidcorp.
Okay.
So it's you can see. I mean, for a business like Checkers to be spending some time on this, you can see why it's an attractive place to play.
Yeah, absolutely. So in terms of the metrics, I mean, sales, this is the guidance for 2023. They're looking for sales growth of 10% and earnings to grow 30% in 2023. And that's a big number, especially in a recessionary environment, which we're in at the moment.
Yeah, absolutely. So, I mean, it's the joy of operating leverage coming through, and people forget how powerful operating leverage actually is. Sales growth of 10% sounds tame.
Yeah.
But if your expenses are really only doing 6, then go write it in a little spreadsheet. Just make up numbers, 150, blah, 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 and just see what the percentage difference is at earnings level. And that's the story here, And here I expect to see operating leverage because, each distribution center can improve its capacity utilization. The more restaurants come on, the more that local DC is busy. So on this business, you expect to see operating leverage. And remember, it works against you just as quickly. If restaurants are in trouble, that distribution center starts to look like a great big white elephant and it gets very ugly very quickly. So that's why I was so surprised on Accenture, because you wouldn't expect that to have operating leverage. And on the downside, Accenture just retrenches people. I mean, it sounds heartless, but that's what will happen. You can't just retrench your distribution center. So when your operating leverage is coming from fixed assets, it's good and you expect to see it, but it's kind of the expectation. When operating leverage is coming from warm bodies, that was a bit of a mind-blowing one for me.
Yeah, fascinating. So just on Sysco, I mean, the share price has actually fallen about 15% since you published your podcast on it. Nothing's changed in the business model. Nothing, as far as I know, has changed in the guidance for next year's earnings growth. The shares have just got cheaper. They've just derated a little bit in line with the whole of the market that's derated. So, I mean, I actually have bought myself some Sysco shares in the last week because I love the story that you told on your podcast, and the fact that the stock is, well off its highs and now at quite an interesting sort of long-term support level. I've gone in and bought some of those for my long-term portfolio, and obviously we'll collect the 2.5% dividend yield in addition, while I wait for markets to recover. So quite happy with that one. And you own that in your portfolio too, right?
So I was actually also waiting on Sysco. So, we looked at it and we said, look, you can go with a gentle approach, but macro volatility, we actually said literally macro volatility may give you an opportunity to add to the position. So, hey, here we are. I'm also waiting. I really don't think it's a bad time to start adding some. I really don't. It's a very interesting business. And one of the other things I just wanted to quote from the report, we always look at the long-term share price CAGR, so that's compound annual growth rate, because it just tells you what has happened, right? Don't ignore history. So fascinatingly, over 10 years, share price CAGR 10.8%. Over 5 years, 10.7%. How consistent is that? And there's a pandemic in that period.
Yeah.
So It's just incredible to see what this company can do. And the one point we certainly made was, if you're looking to buy this as a post-pandemic story around restaurants recovering or whatever, you are way too late.
Yeah.
The market is months ahead of you on this one. Now you're buying it because you like the long-term story in general. And very different to, just a comment on Bidcorp as a local example. Bidcorp is very Europe heavy, whereas Sysco is very US heavy. So if you enjoy pairs trading, there is a relatively interesting long short here. Maybe.
Yeah, absolutely. And also given the fact that, the US is energy independent, whereas Europe is not at the moment, making life difficult in Europe right now.
Absolutely.
All right, then let's get to the last company on the list for now, and that is Ferrari. And I love this. The Americans have quite a cool way of coming up with their share codes sometimes for the stock. So Ferrari's share code is RACE, RACE. Another one in the automotive space, which I love, is the Harley Davidson share code, which is HOG, HOG.
Yes. And have you seen Porsche? The new Porsche
yes,
share code
911.
Yeah, it's P911,
Yeah,
P911. I love it.
Yeah.
And there's 911 million shares.
Yes, I saw that. Yeah, that's very cool. So fun. But let's talk about Ferrari. And again, if I had to give my one-liner for this after listening to your podcast on Ferrari, I'd say the ultimate luxury goods brand. And people listening to this podcast might think, hang on a second, luxury goods are watches and expensive handbags and things like that, not motor cars. But Ferrari is more than just a motor car company. I mean, obviously we know the cars, we love the cars. There is a luxury, like a sort of luxury items element in addition to the cars, but that's not big. But it's really, when saying that, it's the people who buy Ferraris are the same people who are buying very expensive watches or very expensive handbags, right? It's just another luxury item on their list, isn't it?
Yeah, it's the finer things in life. That is the reality. And Ferrari's tech backs it up. I mean, most people have never driven a Ferrari. I've been very lucky to drive two on proper roads. They are different. They are very different. Like there's a reason why these things cost what they cost. And there's a reason why they have the reputation that they have. The Ferrari 458 is the most recent one I drove. A friend of mine has one. And it's insane. I've driven lots of fast cars. There's nothing like a 458 and the way it behaves on the road. So, we can fanboy about this thing all day. And obviously when we did this show, Mo also likes cars. We were very conscious that there's no value here in going, oh, we love Ferraris, just buy the shares. So we didn't do that. You've got to look deeper than that. And the deep story here is that it is a luxury goods company. They've actually just hired a senior exec. I've forgotten now where she was previously, but it was one of the luxury goods businesses. She's now coming as the sort of head on the marketing and the branding side. And the CEO in place now has a tech background. So, these are by no means mechanics who work themselves up through the story. Ferrari understands that its future is where tech and luxury meet ultimately. And Ferrari is just the most aspirational brand. Every single person knows the brand Ferrari. There's no one who doesn't know that brand. And yes, a lot of people will say, oh, I'd never have one of those. Or, oh, I hate them. 99% of people who say that can't afford them. So the reality is there's a lot of people who love them, and yet they still have a relatively low market penetration among what they define as ultra high net worth or high net worth individuals, which tells you there's still room to grow in this thing. They actually have a scarcity model. So they deliberately constrain their manufacturing and their supply to drive demand. Ferrari is not interested in selling you a Magic Market subscription for 99 Rand a month. They want to sell you very few subscriptions for 5,000 Rand a month, and they want to sell you even fewer super subscriptions for 50,000 Rand a month on an invitation only basis. I mean, that's the best for me. The collector's list. You get invited to buy the Icona models, as they're called, and they are like eye-watering amounts of money. People think 3 million Rand for a car is a lot of money. And of course it is. It is by any measure, but not in this world. In this world, 50 million Rand is a lot of money for a car.
Yeah.
That's what you're dealing with here. And the margins on each one are just eye-watering. It's incredible.
Yeah. And what I really liked about that is, again, like this is, we're talking the very, very sharp end of capitalism here. But like you said, to get into those Icona models and to be a part of that collector's club, you have to buy the next collectible Ferrari when they bring it out. Because if you don't, they'll just take you off the list and you won't be asked to buy the next one. So it's kind of like also a little bit like your Hotel California analogy. You know, you can check out, but you can never leave. You know, once you're in that club, if you want to stay in, you better buy that next collectible Ferrari for 50 million rand.
Yeah.
Else you ain't going to be on the list for the next one after that.
Exactly. Hotel Maranello in action.
Yeah. I also found it interesting that the client base for Ferrari is younger than what a lot of people might have thought. 40% of clients are younger than 40.
Yeah.
I thought that was quite interesting.
Me too. And I actually, when I read that, I was like, okay, you know, Psycho has the top 35 under 35. I've never had any interest in that, but 40 under 40 to have a Ferrari is a goal that I can get behind.
yeah, because you're still there. You're still under 40. I've missed that boat.
I've still got time. I'm only 34.
I'm 43, so I've missed that bus. I did have a Porsche before 30, which is nice, but for a Ferrari before 40 is not that. I've missed that bus, unfortunately. I might have to see. Maybe if I'm lucky, I'll get one before I'm 60.
We've got to get the stat for Ferrari buyers under 50, and then we know where we're playing.
That's what
maybe it's 50 under 50. Who knows?
Yeah. Interestingly, they've got their new SUV, or you don't like to call it an SUV, and I'm kind of in that same camp. It doesn't look like an SUV. It's more like a sports car with a high suspension. The Pura Sang, I think I'm saying it right, or I hope I'm saying it right.
Apparently Puro Sangue, but I mean, good luck. Like everyone's going to say their own version of that thing.
Yeah, Pura Sangue. Okay, so it's the Ferrari 4-seater raised body. If you want to call it an SUV, it's not an SUV in my eyes, but it's an absolute thing of beauty. Now, other manufacturers, well, let's think of Porsche. I mean, Porsche has done very well with the Cayenne and the Macan, but this is different. Ferrari is going to limit the production of those as well, and it's because I initially thought, okay, well, this is going to be a high volume vehicle in Ferrari speak, but it's not, is it?
No, it's not. And I mean, Porsche, the SUVs changed Porsche. You know, if you go back to the pre-SUV days, they didn't really have money when the 996, 911 came out. Don't worry, I won't turn this into a car podcast. But, you know, when the SUVs came out, they suddenly started to make cash. And in 2021, the Cayenne and the Macan together were 57% of Porsche's deliveries, right? So that's almost 60% of the business now is selling SUVs. And Porsche does it very, very well. To be honest with you, my dream car for Mrs. Ghost is a Macan. Like if I could afford one for her, I'd buy it right now. Yeah. They are brilliant. Ferrari's not doing that. They are going to keep the Puro Sangue to less than 20% of total shipments, which is still quite a big proportion of their business, right? It's one model doing a fifth of their business.
Yeah.
But they don't want a situation where everyone can run around with a Ferrari, SUV in inverted commas, because again, it just dilutes the brand. They want the majority of Ferrari cars on the road to be sports cars. They actually, the CEO has this lovely quip at one of the recent market days, or maybe it was the chairman, doesn't matter. But basically he said, they asked him about autonomous driving. He said, we want people to enjoy the cars, not the microchips.
Yeah.
So there's no plan for autonomous driving at Ferrari. Why would there be, right? It's completely not on brand. And the SUV is a big step. Lamborghini has done incredibly well off the Urus. Yeah. Aston Martin, all they've really got now to keep them afloat is the DBX. So this market, and look, I get it. I mean, you've also got kids, Scott. Let's face it. It's lovely to pretend that in your 30s and 40s and 50s, maybe 50s when your kids are grown up, it's easier. But when you've got young kids, a 2-seater car, unless you've got loads of parking space where it can literally be a weekend toy, it's just not practical at all. Even a 911 is too small in the back, really, for kids. The new ones are not too bad. Yeah. So this model for Ferrari just makes a world of sense. I cannot think of a more exotic and exciting way to take your kids to school. And if you've got this kind of money, then you're going to live your life, right? That's how people are. That's how capitalism works.
Yeah, that's it. All right. So let's talk about the business side of it, because as much as you and I love talking about cars, and we could probably talk about it all day, let's talk about Ferrari as the business. I mean, valuation wise, it's never cheap. It's on a 25 times PE at the moment. But then again, I guess that's the reality is quality is never cheap, is it?
No, it's not ever cheap. I do think that Ferrari benefits from an emotional premium. Yeah. I must be honest. I feel like a lot of people just want the share. If that makes any sense, it's the super aspirational brand and business. And it's the kind of thing where people are scrolling through a share portfolio going, what should I buy next? Oh, Ferrari's listed. Like, I would love to have that in my portfolio. So, I mean, that won't move the dial. It'll mainly be institutions, and there's still big insider holding, massively so. This is Italian mafia stuff, goes all the way back. Italian captains of industry sit behind this. But it is a very expensive valuation. It's way higher than LVMH or Richemont. And that's your comparison, by the way. Don't go and look at the multiples that BMW is trading on. Then you're completely missing the point of Ferrari's business. This is a luxury goods business. You need to compare it to the other guys. Hermes is really the higher multiple than Ferrari, and that's an even more ultra premium business. I must be honest, I know everything about cars and I know nothing about high-end handbags and everything else. I just have no interest. Everyone has their vices. Even the high-end watches, for me, like at the very top end, really, I don't get it. They all tell the time. I suppose people will say to me, but the Ferrari gets you from A to B.
Yeah.
And it's a similar argument. But I'm told that, Hermes is kind of a really good comparison to Ferrari in terms of real scarcity. And that trades on a higher multiple than Ferrari. So the more scarce it gets, the higher the margins, the bigger the multiple. But the reality is Ferrari does feel somewhat overpriced to me at the moment. I'm not adding more at this price. I do own Ferrari, partially because in the pandemic, I sat down with Mrs. Ghost and I just said to her, you choose one share, I'll choose one share. Choose something aspirational for fun. So she chose Disney and I chose Ferrari, which is why I think there's some kind of emotional premium that sits inside this thing. And a lot of the return since listing has been multiple expansion. So this is a important fundamental point. When you're looking at the sources of return, obviously if something's done 10% a year and earnings have done 10% a year, that tells you that the multiple has stayed the same, right? And that's kind of cool, because then you look at this and go, well, as long as the earnings story continues, this stock is not going to hurt me. It stays at a certain multiple. When the multiple has expanded substantially, it means that the market is now placing more value on every dollar of earnings that Ferrari can manage to produce. And that is dangerous, because if the sentiment changes, even if the underlying business is just as good as it's been for the last 5 years, if the sentiment changes, you can be 30% down easily. Yeah. And that's what's been happening in the market. So Ferrari's down. At the time we did the show, it was down 23% this year. I'm not sure offhand what the year to date is now, but this is the risk you take when the multiple has expanded so much over the years. And that's why I always look at where something is trading versus its historical multiples. It just helps you understand what risks are you really taking.
Yeah. Okay. All right. Super. So we said we'd cover those 3 stocks, but what I also asked you before the podcast is if you were to go and look at all of the 43 companies that you've covered on your Magic Markets Premium podcast series over the last year since we last spoke, and you had to pick 5 of those stocks to add to your portfolio now, what 5 would they be?
Oh, it's an interesting question, isn't it? So I think I would probably happily add Accenture at the moment. I think for all of the points raised.
Yeah.
I certainly wouldn't be sad to add Sysco, although I think it's possibly slightly earlier. We did have a look at Levi Strauss, and that looked pretty good at the time. We looked at that back in July.
Yeah.
So that's something that might be worth considering, actually. Long term, I would watch something like Lululemon, but you've got to watch the valuation. So I'm not necessarily saying I would add it right now, but Lululemon had a lovely business model.
Yeah.
When we sort of unpacked that, we did that show back in April. It's just a brilliant brand. They literally built the athleisure market. I mean, it's phenomenal. You won't see stuff like that very often. I'm sad to say that with the way the world is going, Lockheed Martin is probably not a terrible thing to have in your portfolio. It's very hard to believe that US defense spending is going to go down from here with what's going on. I wish it was different, but sadly it doesn't seem to be. And then, and I don't know if I've hit 5 yet, but something that is worth, it's one of those stocks where who knows what's going to happen, but good old Meta, it's burnt me pretty hard. In fact, it's burnt me very hard. But at some point, it's got to be a buy.
Yeah, Meta, Facebook.
I see there's been a lot of news this week around their VR side. Who knows? Last one I would definitely touch on that I do really like is PepsiCo. Great business. They really do well in the snacks aisle, massively so. They've got Lay's, they've got Doritos, so that's a win.
Yeah.
And I think that kind of covers it. Visa's a goodie as well. Oh, there's so much in there, and you really got to go and dig in and just have a look at the combination of the technicals and the fundamentals. That's always the trick, right?
Yeah, well, it is. It absolutely is. But now to listeners who are listening to this podcast, I'm just going to reiterate again, go and subscribe to Magic Markets Premium if you aren't already subscribed. It's 99 Rand a month. It's ridiculously cheap for the value that you're getting. And you get 4 podcasts a month. But in addition to that, there's now this enormous library of intellectual capital sitting there. As I say, there's 43 companies covered in this library. I mean, you could go and sit and binge listen to these podcasts. It'll take you a couple of days to listen to all of them. There's unbelievable wisdom in all of these. And why I stress this now is because a lot of these companies that you've covered in your Magic Markets Premium podcast are very good businesses. And a lot of them are on sale right now. They're trading at a significant discount to where they were a year ago. So I think it's, for listeners of this podcast, please just do yourselves a favor and go and listen to Magic Markets Premium and catch up on all of those past episodes, because it's incredibly educational and it'll certainly help you in terms of making your own investment decisions. Last point I want to touch on, because we're now running out of time, Ghost, is an initiative that you are embarking on. I don't know how far along you are with it, but I know that we've said you're a petrol head. We know that. You were big into kart racing earlier on in your life. And I understand you're getting back into that, and you've got a new charitable initiative that you're looking to set up.
Yeah, that's right. So it's going to be called Racing for Rainbows. And basically what I'm looking to do is tap into the racing fraternity. It's a sport that is very expensive. And what that means is that there's a lot of people who have money and who do the sport. I mean, that's the truth. So you've already kind of filtered out for whether or not people have the means to actually support something. And I just think that there's an ability to, racing is a sport of passion. And if people can raise money around their racing, whether they get their friends and family to say, if I come top 3, please won't you contribute something to my race result this week, and actually pool that money together and use it for specific interventions. So stuff like, kids who need help with a medical bill and their parents can't pay. I mean, I'm a dad. I cannot imagine a situation where toddler ghost needs something and I can't pay for it. I have this strong belief that a big percentage of crime in this country is driven by desperation, because I don't know what I would do to help him. I'm sure I would do a lot of things that are not legal, bluntly. So, there's a lot of people in that situation. It's hell of easy to judge from the comfort of your own home what someone else is doing to feed their family. So the idea with this would be just to help with specific interventions. So it's not to support a foundation or a charity or something specific like that. It's rather to say, here is someone who needs help because of an injustice in the world. What can we do to help? Pool those funds together and see what we can do. So the drivers who sign up as ambassadors would actually have a SnapScan QR code, which they would be able to put on their race car, on their kart, on their rally car, on their bike, wherever they want to put it, on their websites, raise money, and it all comes to a central place. So it's very exciting. I've already got a couple of people who have committed, people who are very serious racing teams. And yeah, I'm excited to see what I can do with it. I don't know where I'm going to get the time, but I do want to start to use the platform for a greater good. And I think there's no shortage of ways to do that in South Africa.
Yeah, well, that sounds fantastic. That's awesome. Well done. All right, Ghost, it's been an absolute pleasure talking to you again, as it always is. I'll certainly be looking you up again another year from now so that we can catch up towards the end of 2023 and pick up on whatever's happened in your life and your business in the next year from now. But all the best with Racing for Rainbows. It sounds like a wonderful initiative, and all the best again with Magic Markets Premium and with your business. It's brilliant. Everything you're doing is just amazing to watch, and I'm a very keen spectator from the side watching your career flourish. Well done.
Thanks, Garth. You've always been a big supporter of this, and I really appreciate it. So thank you very much.
It's my pleasure. Take care.
Thank you.
You're listening to Talking with Traders, a podcast series brought to you by IG, a world-leading online trading and investment provider. If you haven't checked out the IG online trading platform, please do so and visit IG.com. Also, make sure you subscribe to the podcast series on your favorite podcast app or website by clicking on the subscribe button, and you'll be notified weekly as we release new episodes. Thanks for joining us for today's episode of Talking with Traders, brought to you by IG, a world-leading CFD provider. We really are privileged to have such a leader in the field of online trading involved in this series. Please follow us on Facebook and engage with us there. And a reminder to make sure you subscribe to this series by clicking on the subscribe button on your favorite podcast app. If you've enjoyed this podcast, we'd also appreciate if you'd leave a review on the app too. Till next time.